we're going to jump right in first. Let's talk about mortgage delinquency rate falling to its lowest level since 1979.
That is unbelievable.
That's really good on one hand, and obviously, I think there's some obvious reasons why that's happening. I would say that low rates is obviously a catalyst from 2020 and 21 and 2022. I think that's contributing to it. Obviously, affordability has not been in our favor. We've talked about that on recent shows too. But I mean, this metric's going back now. How many years? 44 years almost now. I'm not surprised by it, but I am surprised by it because everything else seems to be expensive, and I think financial pressures mounting on people will eventually cause delinquencies. But right now, I guess we're not seeing them.
I guess I'll ask, for how long are we going to see this?
That's a great question.
For how long right now? And I think that's everything that's coming out right now, we're still seeing it in these past reports. I mean, consumers are still spending. That hasn't gone down. And until that starts to come down, then I feel that people will start feeling it. Yeah. I remember you mentioned something that when people start, really feeling the financial pinch, the last thing that they stop paying is their house. We're already starting to see credit cards go up, car payments as well, missed payments, and the last big one, of course, we know is your mortgage. So that's why I asked, for how long until we start seeing that number go up?
Here's the thing, guys. We got to remember that when it comes to the government, the numbers are always going to be fluffed up a little bit. Just like unemployment, right? Mm-hmm. You're not considered unemployed if you're receiving a check. So now what's happening is, if we're seeing these delinquencies, what's happening is one thing that we've learned in 2020 when COVID happened. We got to see a lot of loans get modified because you were in forbearance. And so when that term of first started with 6 months, we went to 12 months. Mm-hmm. Then they did extended another 6 months. And then I got extended. I was hearing some people like 24 months without making a mortgage payment. And then all of a sudden, voila, your mortgage is now converted all into one. So whatever you were in forbearance, let's just put it all together in one, and let's reduce your interest rate.
So what you're saying is it's kind of both and. It's a function of the low rate environment that we had where people did refinance into, and it's also a function of having forbearance.
Yes. So what we learned right now in 2020 is that now we're able to do loan modifications. And that was something that wasn't existent in the mortgage meltdown. That's something that was a new thing. Well, in 2020, it sounded like we were already really good at this.
I feel like they're like, hey, we've already gone through something like this before. Yeah. I think there's something smart that we can do here.
Exactly. So right now, a delinquency is not going to count because it's under that loan modification right now.
Yeah, because it actually isn't delinquent, but it's the function of that being
That's
changed.
Correct.
Yeah.
But we're seeing a lot of people that cannot make their mortgage payments right now, but because they're going through some type of loan modification, it's not considered delinquent.
Yeah, and it's not delinquent yet.
Yet.
So the tie-in,
that's actually really good insights.
I think the tie-in here is part of the same article was talking about despite the encouraging news, the Mortgage Bankers Association reported signs of consumer-related stress with delinquencies rising for other forms of credit, including credit cards and car loans. Ding, ding, ding. Guess what? Which are connected to the
federal funds rate.
Was that multiple choice?
So
no, it was the right answer. How to go for it. Took a wild guess. Thank you, everybody. Appreciate it.
So what we've seen is there's been immense pressure since March of 2022 when the Fed started ticking up rates that now is spilling over into these consumer car loans and credit cards where they are directly affected. And there are going to be slowdowns in that. And you're mentioning there's delinquencies in that. And I think that is something we're going to see for the foreseeable future until you can either correct that with new income, more money, a second income, third income, side hustle, or some sort of modification or some sort of forgiveness. And I'm not sure that we're going to see forgiveness. I'm seeing repossessions in cars and that kind of thing. But I will tell you, side topic, a friend of mine who is a bankruptcy attorney has recently seen an uptick of bankruptcy interest and cases because of these kinds of things, rising consumer debt, medical bills, collections, things like that. So this is something I think we should watch.